All right, so the rehash, you have cash flows. Some of them are in the next few years, some of them are way out there. When you discount them, the near term are going to be the bulk of your liability because they're only a few years out. So when you discount something out 3 years, it's a bigger part of the liability. So the 3-year cash flow is 86% of your liability. The 30-year is only 14%. But if interest rates change, the liability is going to jump quite significantly, 16%. And most of that is going to come from that out year cash flow. Very simple math. You're just taking $500, dividing it by 107 to the third or the 30th, and you do it to the 5%. If you look at how Arnott did it, let me go find Arnott real quick. I don't really need you to fully understand Arnott's approach, but I want to show you that he's a little bit more complex, but it is important what he's talking about. So what he's doing here is these blue bars are the actual cash flows. So at USAA, we had an actuary. USAA actually had a full-time actuary who did nothing but work on their pension plan. And he's still there, smart guy. So he would send me the forecast of all the cash flows, but this is the cash flows undiscounted. But it's not in dollars, it's at the percentage of the total. So you can see they have people haven't retired yet, Everybody starts retiring and then they start dying. All right, I used to tease him. His name was Asa. I go, Asa, your cash flows look pretty good, but year 74, you're really sure about that? I mean, it's a forecast out, right? He's trying to figure out when people retire, when did they die, all that kind of stuff.
Is the x-axis how many years they've been at the company? Is that it?
It's number of years just when the cash flows happen. So it's not number of years, although there is obviously a correlation between number of years because you invest more. The orange or the yellow are those cash flows, but discounted as percentage of the total. So the front end is the majority of your liability because you're only discounting out 3, 4, 5 years. All right. And then he graphs the sensitivity to the interest rate sensitivity. I find this chart really, really hard to read, a little more difficult. Do y'all like, I mean, you can think either way, but I like having just 2 cash flows. It just makes it a lot simpler. But essentially what he's showing is the out years have a much bigger impact on your actual volatility versus here. It looks like they're a really small part of the liability, but they're actually a pretty big part of the sensitivity of the liability. And it's asymmetry. None of y'all took my investment class. This is kind of frustrating. Usually this class is like 30% of people took my investment class. Now it's 0% because I haven't taught it in a couple of semesters. Let's see if anyone can think of this. So we talked about duration. Duration is very symmetrical, but he says these cash flows are actually not symmetrical. What's the word you use when they're not symmetrical? Starts with a C. You have duration and convexity. These cash flows are very convex. He talks about it here. You can see it in my numbers as well. If bond yields were to rise, the net present value would fall 37%. But if rates fall, the liability would rise 62%. It's not symmetrical. With duration, it's symmetrical, right? You say if interest rates rise 100 or 200 or fall 100 basis points, rise 100 basis points, the net worth goes up 5% or goes down 5%. Here, when rates rise, the liability falls 37%. When they fall the same amount, the liability goes up 62%. These are highly convex. We love convexity if it's an asset, but this isn't an asset, is it? It's a liability. You like it that, if interest rates rise, my bonds will fall 10%, but if they fall, my bonds are up 15%. We like that. That's great. But with a liability, you don't want that. So we're going to hedge this liability. What do we need? What kind of asset do we need? Do you need an asset with high convexity? Yes. So if you're going to hedge this liability, when you know when rates fall, the liability is going to jump a lot more than it's going to fall when rates rise. You better have assets to do the same thing. All right. So it's not symmetrical. That causes you a problem. So I hate this sentence. You can read my rewritten sentence. What does this mean? It means most plans are holding too little in bonds that are too short in duration. Let me see if you like my definition a little better. It means that most plans are holding too little in bonds, and the bonds they do hold are too short in duration. And that's absolutely true. Remember, this bond has really long duration and really high convexity. You're not going to hedge that with a 5-year corporate bond, which is what most pension plans hold. 5-year corporate bonds. What do you need? You need very, very, very long-term bonds. In fact, you need bonds that don't exist. You need bonds with 30-year duration. Can you think of a way we can add duration and convexity to your portfolio when no bonds exist? Is there any security you could buy that we've been talking about in this class that would add significant duration and convexity to your portfolio? We talked about it last class. Interest rate swaps, right? He doesn't mention them, but an interest rate swap is a really fast way to get a lot of duration and convexity. So, so the long duration yields are too low to allow inclusion in portfolio. That's been kind of the argument is I don't want to buy those long duration bonds because they're only giving me 4 or 5%, but they're going to reduce your risk significantly. Remember, you don't have to put 100% in there. He's saying you only have to do 10, 15%, and you can eliminate 68% of the risk. So that's his main argument. I don't agree with it. I would go further. My guess is if he were here, which would be wonderful, he would probably agree with me from an economic standpoint, but from a political standpoint, what firms can get away with, he probably would not agree with me. My advantage was I had a CEO that if I told him no one else is doing that, he said, let's do it. Most people, when you say no one else is doing that, when you have fiduciary risk, you have career risk, they say, no, we're going to do what everybody else is doing. The guy who took my place at USAA when I retired, some of y'all know him because he's here at UTSA. He came from AIG and he wanted to do what we did at USAA, but their board wouldn't let him because it was just too way out there. I had a CEO that was perfectly fine. Yeah. In fact, for him, if no one else is doing it, that's like evidence that's the right thing to do because he was convinced people weren't paying attention. So it helped me on that side. So I think Arnaud is suggesting something that says you can get away with this. It's not so far out there. You have all this fiduciary risk. You only need to hedge 14%. The real change is instead of buying 5-year bonds, you need to buy very, very long-term bonds to get as much of that risk taken care of. So if a pension plan would invest a small portion of its assets, say 14%, in long-term securities, it would eliminate a huge part of that interest rate risk that's now flowing right through the income statement. All right, so it makes sense what he's talking about. He adds a little bit more. We may not get so much into this. The other big problem with, well, we actually will get into it. The other big problem with pension plans is a lot of them have a cost of living adjustment, which means they also have inflation risk, which really complicates the picture. So we'll talk about the risk of the liability. All right. So when we talk about this and on the exam, you have to be really clear on the exam. So there's 4 risks that portfolio managers have. The peer risk, which drives the career risk, the asset risk, and the ALM risk. All right. But then the ALM risk has specific risk. So you have another list of risk under that. All right. So we'll get into what those are, including inflation and a few other things. All right. So you get a good sense of Arnaud's argument here. He argues, and this is where I disagree with him. He argues balance these risks. Try to find a way to balance them. He even says, you know what? See if you can get 2 out of 3 of them good. So you got 3 risks. One of them's not doing well, but the other 2 are doing well. What's the problem with that argument? One of them's a huge risk and the other 2 are much smaller risk. My argument is take care of the big risk and don't even worry about the other 2 risks. Peer risk especially. How can you can completely eliminate peer risk by doing what? Just index everything. Just buy the market. Don't even try to beat the market. That's what we did at USA. We just indexed. It was quite humorous. So we'll get into this more, but so at USAA, when we did the pension plan, when I got the pension plan, we had maybe 12 managers. And our pension committee, we would go in and we spent hours going through, okay, manager A, they're underperforming. They've underperformed last year, but they were doing well before that. Do we fire them? Do we hire them and keep them? Oh, we think we need to fire them. Okay, now we got to go out and find a new manager. All this time. For what? Pure risk. Small percentage of our risk. And so 2 or 3 hours. I kid you not, after we made this change, our pension committee meetings took less than 5 minutes. We went from 2 hours to 5 minutes. What did we do? Asset return, liability return. Any questions? Not even 5 minutes. Because we hedged it. Our assets are up 8.2%. The liability went up 8.15%. Any questions? Everybody's fine. Think about the committee time. You have all these, when our CEO sat on the committee, our CFO sat on the committee, the president of the individual companies. Is it really good use of their time to spend 2 hours talking about why manager made 8% instead of 7.2%? And should we fire them or not? What a waste of time. My department loved it. They started going to conferences after we did that, and they would sit at lunch and everybody at the room, everybody at their tables talking about, oh man, we have these 10 managers. Last year, 5 of them did bad and the other 5 did well. This year, the 5 that did bad are now doing good, and 5 that did good are now doing bad. Unfortunately, we fired the 5 that are doing bad, and so we don't have them. We hired 5 others that aren't doing well. And my department comes back and says, boy, we're so glad we're not doing that anymore. A lot of waste of time, but you spend 99% of your time doing that, right? Because you got to look at every manager, you have to replace them, you got to ask. Big waste and has such a small impact. So what we said is let's focus on what's important. Are our assets doing? And then what about this? Asset return minus 5.2%. Liability return minus 5.21%. Any questions? Does that look okay? What was your asset risk? Pretty bad. You lost 5%. But your liabilities are down 5%. So, you mentioned net worth risk, right? Which is essentially, how did your net worth do in this case? No impact. What's the duration of your net worth for this particular plan? Essentially 0, right? You completely eliminated interest rate risk. And so it was so much fun going in and just the meetings were so short. This is not what Arnaud is recommending. He's still recommending they take some risk, put some stocks in a portfolio, but just that 14%, that's the long tail, at least hedge that out, get rid of some interest rate risk. Our argument was, we'll get into this more. The reason this pension plan exists is to pay those liabilities. We should have assets that ensure that we're going to pay those liabilities. That should be the only thing we care about. Let's forget peer risk. We forget asset risk. Let's just hedge the pension plan. So it was pretty radical and we got away with it. But be careful. Some students get really confused that Arnott and I are saying the same thing. We're not. Granted, he's a lot smarter than I am, but at the same time, I really think he would agree with me. I wish I could bring him here. Maybe I should email him. Maybe he's retired now. And it would be fun having him here. I wouldn't say much. I would just listen to him. But smart guy. Now, I did talk to a guy. I should find, he's still out there. I could find his stuff. His argument was stocks are long duration assets. That was his argument. Stocks are long duration assets. Essentially, what he was saying is the valuation for a stock is dividends divided by discount rate minus growth. The discount rate has interest rates in it. So when interest rates rise, stock prices fall. When interest rates fall, stock prices rise. What's wrong with this? What happened in 2008? Interest rates fell. What did stock prices do? They fell a bunch. How did that strategy work for you? Horrible. So yes, stocks do have long duration embedded in them, but they have other stuff that's far, far more important, like growth, sensitivity, recessions, and those other things. So once I heard him, we were talking to him as a consultant, and I just stopped talking to him. It's like yeah, theoretically what you're saying is right, but you look at the numbers, stocks do horribly when interest rates fall because interest rates fall in a recession, and that's when stocks are falling, interest rates are falling. So yeah, I didn't buy that argument at all. All right, so there's R naught. So now you're ready for my argument. This is the one you have to focus in on the exam. This is a tough question, but it's my favorite question, so I'm going to ask it because it has practically everything you learned. Let's see how good you did learning finance and how many years? You've been here 4 years. So everything you learned is in this question. Borrowing to invest. Will the value of a firm increase if the firm borrows at 3% and invests in a well-diversified stock portfolio with an expected return of 8%? You go out and announce to the stock market, hey, we're going to borrow money. We're going to go out and borrow $2 billion. We're going to borrow 3% because we're a rated firm. We're going to stick it in the US stock market. We think the stock will make 8%. Are the stockholders going to say, oh man, that's great. I'm glad you're going to do that. All right, so that's the question. It looks good, right? 5% spread looks pretty good. So what would the arguments be there? So what can you bring into this argument? Just about everything. Why do I apply this to pension plans? Because it's essentially what they're doing. They're not borrowing money in the market. They're borrowing money from their employees, but it's the same thing. They're borrowing money from employees. They got to pay them back in the future. Should they stick that in the stock market? Will that make the value of the firm go up? Everybody understand this part of it? How you make that connection? It does apply to borrowing money. I mean, AT&T could go out and actually borrow $3 billion and just stick it in the stock market, which was my comment to the AT&T guy is, you do this with your pension plan, why don't you go all out and just borrow money and stick it in the stock market? If that's such a great thing to do, then just keep doing it. You got plenty of more room to borrow money. Why not? Would that increase the value of the firm? So first thing we'd ask about what happens to the discount rate of a firm when they borrow money. Anybody remember that? What happens to your beta when you borrow money? Does it go up, go down, stay the same? Goes up, right? Borrowing money makes the firm more risky. So if you borrow money, your return on equity is going to go up, but your cost of capital is going to go up. Those two could just be a wash. Yeah, you're going to make a higher return, but you're riskier, so you have to make a higher return. So that one's a little bit hard to say. We're going to talk about the liabilities in themselves because this is actually pretty huge. Because a pension plan is not like borrowing money, it's like borrowing money on steroids. Pension plans are extremely interest rate sensitive. So we'll talk about the value on the fund, and then we'll talk about why do pension plans ignore theory. So this is one place where I'm giving you the academic argument that I actually agree with. And this is a place where practitioners disagree with academia, and I actually agree with academia on this one. We'll talk about the demise of the U.S. pension plan when they changed the accounting rules, which I think is pretty sad. And could this apply to you? So we'll talk about why you have borrowed money, essentially, because you have a huge debt you got to pay back. It's called your retirement. You're going to have to pay yourself back in retirement. Am I arguing that you, as especially younger students, that you shouldn't be in the stock market? You took my life insurance class, you'll know the answer to that. There's something you have that AT&T doesn't have. Anybody remember? Human capital. Yeah, human capital changes the picture dramatically. So we'll get into that a little bit. So yeah, a 20-year-old should have just 100% of their money in the stock market. That seems to violate this particular thing, but it's a very different equation. All right, so let's get into this. So the debt are the pension liabilities, and then what you put that debt money into. So a typical firm will borrow money and they'll put it in projects that have positive net present value, and the value of the firm will go up. Okay, that's the normal. Here, we're not borrowing money, we're using a pension liability. And what are we investing the funds in? Are we investing it in projects in the firm? No, we're sticking it in the stock market. Very, very, very different. So CAPM, why do we talk about CAPM so much? Because it's still out there, even if you disagree with how to calculate the numbers, the theories works pretty well. If you don't know CAPM, go back to Wikipedia and learn it. It's like the single most important theory in finance. You just see it all the time. You probably saw it every one of your finance classes, haven't you? Even in my P&C class, they had to see it. We just talked to have a whole, their first exam has a big question on should corporations buy insurance, and they're going to use CAPM to answer that question. So it's an important theory. What is CAPM? I mean, first of all, who gave us CAPM? Remember? William Sharpe. Remember William Sharpe? Sharpe with an E. William Sharpe, Nobel Prize winner in economics. He's still alive. He's probably 90 years old now. This is the most referenced dissertation ever written in the history of finance. Extremely important paper. What did he say? Well, if you're looking at the risk of a corporation like AT&T or Microsoft, there's two risks. There's systematic risk and there's unsystematic risk. Systematic risk is the risk of the market itself. So a firm that has systematic risk in that it's going to be hurt if we have a recession, it's going to be impacted by interest rates changing, inflation. Those are the risks that every stock is exposed to, your systematic risk. How does that measured? It's measured by beta. So the relevant risk, Warren Buffett, William Sharpe said, there's one risk of the two that's relevant when you value a stock, and it's the systematic risk. What's the other risk called? Company specific, idiosyncratic, unsystematic risk. What does William Sharpe surprisingly say about that risk? He says to ignore it. Isn't that crazy? Ignore it entirely. Why? Why would you ignore that risk? You diversify with real easily. You just buy 20, 30, 40 stocks and it completely disappears. If one firm has something bad happening, another firm has something good, they offset each other. So William Sharpe says the only risk stockholders should care about, investors should care about, is systematic risk, which is the risk of your exposure to systematic things like recessions, interest rates, inflation, those kind of things. How much of a risk of a stock is systematic versus unsystematic? We'll talk about that later when we talk about diversification, but the majority of it is unsystematic. 80% or more of a stock's risk is unsystematic, it disappears. So William Sharpe's making a pretty bold statement. When you buy a stock, you can just assume away 80% of its risk. You only have to focus in on 20%. And that 20%, all you care about is how it's relative to the overall stock market. So you may remember the two types of stocks. High beta stocks, what do we call them? Cyclical stocks. And low beta stocks, what do we call them? Defensive stocks, right? So a cyclical stock is what? Is one that gets really hurt in a recession, really sensitive to macro factors. A defensive stock is one that might not love recessions, but it's going to do better than the average stock. What's an example of a defensive stock? You'll think of a company out there that would have a low beta. Walmart, Costco, utility. What's a high beta stock? Huh? Maybe Palantir. I don't know enough about Palantir. Probably so. Advertising tends to be in systems tech. But I mentioned Ford too, travel companies, airlines, those that are just when people cut back a lot because they're worried about a recession, worried about losing their job, then those are cyclical stocks. So there's high beta and low beta. The key for us, though, is the cost of capital formula. The weight of debt times KE plus the weight of equity times KE. That's a formula you've seen a million times. The question is, what does debt do to this formula? What does debt do to this formula? It's going to raise the beta. And if you look at this before taxes and before bankruptcy costs, anybody remember who are the famous people who came up? I know y'all hate me keep asking these questions. I want to see how much you're remembering, right? You should retain something. Who are the people who came up with optimal capital structure? Who said that? Christopher, good. Modigliani, um, and Miller and Modigliani, and it's just like it sounds. So optimal capital structure, you even have some YouTube videos there. Here's Wikipedia. So what did they say? They said, you know what? It really doesn't matter. If a firm borrows money, will the value of the firm go up? They borrow money, well, it's true debt's cheaper than equity, but as they borrow money, they're getting the cheaper debt, but their cost of equity is going up, and the two are a wash. And what do they say? It doesn't matter. Doesn't matter if they have 10% debt, 20% debt, 30% debt, doesn't matter at all. And essentially their argument they made was you buy a $500,000 house, are you going to fund that with 20% debt, 40% debt, 80% debt? And their question is, how much debt you use, and how does that impact the value of your house? If you bought a $500,000 house, what is it worth if you use 30% debt? Still worth 500,000 bucks. Right? What if you use 60% debt? It's still worth 500,000 bucks. So the value of the assets is not impacted by how you fund them. Right? That was their first theory. And then they thought, well, wait a minute, what do we know about debt? It's tax deductible. So the US taxpayer is going to cover some of your cost of debt. So yeah, debt has an advantage. So you should use more debt because you get the tax shield. Is this coming back to y'all? You're remembering this from your probably 3013, 30, or whatever the class is. I know Catapacum covers this stuff. They said, yeah, firms should use debt. Well, in that case, let's use 99.9999% debt. And they said, well, wait a minute. You go too far, your debt holder is going to start penalizing you. Your debt cost is going to skyrocket. You're going to have these bankruptcy costs. So they said there's actually some optimal point of optimal capital structure. Well, optimal capital structure. And you remember these images? You've probably seen them. Y'all remember those? As you use more debt, your cost of capital comes down. Why? Only because of the tax shield. It's the only reason. And at some point it starts rising. Why? Because you're using so much debt. Your debt holders are restricting you. They're causing your debt to go up. And supposedly there is an optimal level. Here's the one I like, this one here. If you listen to some of Dr. Damodaran's videos, he actually has models where he will calculate the optimal capital structure for firms. Say they should have 62.3% in debt. This firm should have 41.6. He actually calculated. One video I saw, he showed one firm that didn't have enough debt. It was Disney. They said Disney could increase its value if it used more debt. Showed another firm that had too much debt. I forget what firm that was. They should cut back on their debt. But so this is just a refresher, but it does relate to what we're talking about. Is when you borrow money, it has an impact on valuation because it's going to impact your cost of capital. As you borrow money, the firm becomes riskier. They need to make more money. So even though you're going to invest it to make more money, you need to just because you're riskier. All right. But where are you investing it? Remember, what you want a firm to do is borrow money, issue equity, and put it in positive net present value projects. If you do that, the value of the firm goes up. What is this firm investing in? They're investing in the stock market, a pure beta bet. They're not investing in the firm, they're not investing in unsystematic risk, they're investing in extremely in fact, 100% systematic risk. And this is exaggerated because of the kind of debt that they're using. This is a liability that is extremely long duration. A pension plan is extremely sensitive to interest rates. So I just mentioned in a recession, interest rates usually fall. Stock market usually falls. So you think about this as kind of the perfect storm, right? You go into recession, your liability is going to shoot up because interest rates fall, and your stock portfolio is going to shoot down because interest rates fell because of the recession. It's really, really bad. So pension plans are very long duration liabilities. They're kind of an extreme kind of debt. Very, very, very highly sensitive interest rates, very high systematic risk. And they also have a cost of living adjustment, which makes them also sensitive to inflation. It's like the worst possible liability you could have. Extremely sensitive to interest rates, sensitive to inflation. Just terrible, terrible. And you're going to take this debt on, make the firm much, much, much riskier, and you're going to put that in the stock market, which does what? Makes them even more exposed to the economy and interest rates and inflation. Does that sound like a good value-adding proposition for most firms? All right. So the very existence of the pension plan makes the firm riskier. And for some firms like GM and Ford and these kind of old economy firms that just have massive union forces with high pension plans, yes, it's very significant. Now, I'm ignoring taxes here because it's really complex. I'm going to argue that if we looked at the tax side, my argument would be stronger because pension plans are very strangely taxed in a very, very bad way. But you just have to trust me on that. I can go through those rules. The IRS is real picky about what tax deduction you can take when you fund your pension plan, and it's really bizarre. So even there, it's not like borrowing money and you get this wonderful tax deduction with borrowed money. Pension plans are very, very difficult when it comes to the tax side. There's some pension plans that are short money. They need more money. They need to have contributions from their employers, but the IRS won't allow it. You won't get the tax deduction, and it's just sometimes I remember just going, "Are you kidding me? Why can't we get a tax deduction?" It's like this. The rules are really complex. So we're going to ignore the tax side of this. You just have to trust me that it actually adds to my argument. So the cost benefit analysis, you do a cost benefit analysis, you get the net present value of a project. If it's positive, the firm's value goes up. If it's negative, it harms. You use a discount rate reflecting the project's risk. What's the discount rate going to be if you're going to invest in the stock market? Your beta is probably going to be 1, right? If you invest in the stock market, you have a beta of 1 more than likely. So here's an important argument. You have to let this sink in. Let's think about this. You take $100,000 and your project is the S&P 500. So you take $100,000, you stick it in the S&P 500 and you calculate the net present value of that. What is going to be your net present value, would you guess? Put $100,000 into the US stock market. You calculate out all your cash flows. You get a discount rate. You discount it to today. What would be your net present value?
0.
0, exactly. Why? Because the stock market's giving you exactly the risk that you need. How do you add value to a firm? You do positive net present value projects. What is this firm doing? They're borrowing money, which does what? Makes it much riskier. They're taking that money and sticking it in it. What kind of net present value project? 0 net present value. Does that sound like they're adding value to the firm, or are they destroying value in the firm? So the net present value of an investment in the stock market is 0. Markets are efficient. The price of the stock reflects that risk. You might make 8%, but your discount rate's 8%, so your net present value is 0. The beta of 1, you don't use the WACC of the firm because they're not investing in a project in the firm, they're investing in the stock market itself. So your discount rate is going to be the risk of the stock market. That's the true risk of this particular investment. But it gets worse. Most pension plans try to beat the market by hiring active managers. And how did they do on that? Horribly. That's why my department loved it when we indexed, because it eliminated massive amount of work for us. We could focus on the important stuff. 80–90% of active managers underperform the market, which means the net present value is actually negative. Most pension plans have a negative net present value because they're paying managers to beat the market that are not beating the market. So it gets even worse than that. So just think about it. You offer a pension plan, you're increasing the financial leverage in the worst possible way. It's extremely sensitive to interest rates, sensitive to inflation. It's going to increase the risk of the firm, make its discount rate much higher. You're going to take that money and stick it in something that has a negative net present value, that you are reducing the value of the firm. What would be better for AT&T to do? Just shut down the pension plan, not do it at all. That would be a solution, right? They could just give the money to their employees and say, hey, forget the pension plan. We're going to pay you an extra $10,000, $20,000 a year. Were there employees like that? What's the advantage of the pension plan? Deferred taxes for 30 years. That's kind of nice. So there isn't a benefit to employees. The tax code makes it beneficial. Is there a benefit to AT&T? Well, if they can hire more employees, get better employees because they have a good pension plan, then yeah, it's good, attractive. But otherwise they'd probably be better off just not having a pension plan, which is what most corporations are doing now, not because of this, but because of the accounting. So let's talk about the pension liabilities. So we had 4 risks: peer risk, career risk, asset risk, ALM risk. Now let's just focus on the 4th one, ALM risk. What are the risks of the ALM? So the first one is longevity risk. When you tell someone, I'm going to pay you $2,000 a month until you die, what is your risk? That they live to be 115 years old. You should read the story about the first woman, the first person to get Social Security. She hardly paid anything into it, and she lived a very long time. She came out like a bandit on Social Security. Longevity risk. People live too long. How do you manage that risk? You hire hitmen. That might work. Might be a little illegal. That's a tough risk. You have an asset you can buy that does really well if people live too long. Can y'all think of one? It's kind of tough, isn't it? What do you buy? You could buy annuities from an insurance company, but that would be pretty risky in itself. So longevity risk, that's a pretty tough risk to manage. And it gets even worse. How many times have I said it gets even worse? There's anti-selection risk. So if you got the greatest pension plan in the world and you turn 65 and you're in really bad health, you have a choice. You can take the pension that's going to pay you $2,000 a month until you die, or you can take a lump sum cash payment today and you're really sick. You don't think you're going to make it more than a couple of years. What are you going to do? The lump sum or the pension? Lump sum. What if you're extremely healthy? Could live another 30 years. What are you likely to do? Take the pension. So it gets even worse because you have the anti-selection. What would you want the sick people to do? Take the pension. What do you want the healthy people to do? Take the lump sum. But that's not what they're going to do. So it's even worse. Ace was here to talk about how he actually put that into his model. How did he assume? I did take my lump sum, but I took it because interest rates were really low, so the liability was massive. So when interest rates got really low a few years ago, I was like, it's a really good pension plan. It'd be nice to have it. I don't really need it. I got plenty of money without it. And the liability is massive right now. So I just took it. But so even though I think I'm pretty healthy, might live, longer than the average person, maybe, or maybe not, who knows, get hit by a truck. I decided to take the money, and because of that, and that's kind of the other anti-selection risk. You're trying to decide, do I lump sum or I take the annuity, and then interest rates fall down to 2%. And so your pension plan that was worth maybe $1 million, now it's worth $2 million. You're like, you know what, I'll take the $2 million a day and I'll invest it because interest rates are likely to come back up. So that's the anti-selection risk. So longevity risk, people live too long. And not only that, the people who aren't going to live very long, they're going to take their money today. They're going to make that liability much worse. We talked about inflation risk. Most of these plans have a cost of living adjustment. And so inflation is big. That makes this really difficult liability. Inflation is one of the hardest risks to manage. We saw that in 2022 when inflation-linked bonds underperform, had a negative return. You would think they would have done great in an inflationary period. Gold had a negative return. But the only thing you could have done in 2022 to protect you from inflation was buying oil. If you bought oil, you would have probably been okay. How many people have 100% of your portfolio in oil? Probably not too many of you. So inflation risk is tough. I don't know if I get into how USA managed the inflation risk. And here, just real simply, what we did is we actually under hedged. We made the duration of our assets slightly lower than what we thought it would be, because you'll see a relationship between inflation and interest rates. And then interest rate risk. The nice thing about interest rate risk is it's probably the biggest of those risks, and it's the easiest one to hedge. You've already seen that, right? You can just use interest rate swaps and immediately remember dollar duration gap. Exactly what we did. I got the dollar duration gap of our pension plan. I told that to my broker, and he went out and found me a swap that gave me exactly that hedge. So interest rate risk, you really can eliminate it. Is what did Arnott say? Don't eliminate it, just handle the 14% at the tail. We eliminated the entire distribution. All right, so these are 4 things that are under the 4th risk. All right, make that real clear in your exam essay. So there's 4 risks of investors. That 4th risk is the most important one, ALM risk, and ALM risk has its own unique sets of risk. Everybody see clear on that? All right.
So this is all ALM risk.
This is all under ALM. Yeah, if you're going to manage the ALM risk, like if you're looking at asset risk, you don't care about these things. You're looking at pure risk, you don't care about the risk. This is the only place you care about. This is under ALM. And you notice it really impacts the first 2 really impact the liability only. The last 2 impact the liability and your assets. So you have to be kind of sensitive on both of those. And really, I think from our standpoint at USAA, that 4th risk is the easiest to measure and it's the easiest to hedge. So we said, let's just eliminate it.
Isn't this literally just Social Security?
Social Security is the exact same thing. Yeah. The difference is there's no assets backing it, really. I mean, there are, but they're, yeah, they have some. It's going to run out here in the next few years. I don't think it's as bad as Medicare. Medicare is pretty.
But I mean, it didn't manage longevity risk, obviously.
Yeah. Social Security has a strange thing because you can't really lump sum Social Security, but you can decide whether to take it at 62, 65, or 70. And the healthiest people are going to wait till 70. So they have a little bit of that anti-selection. And they definitely have the longevity risk. But they don't really care. Why? Because it's not their money and the taxpayers are going to take care of it. You guys are going to take care of it, right? My generation has really ripped you 20-year-olds off quite significantly. It's pretty sad. I was telling my life insurance class last time, I see on Facebook these very wealthy senior citizens saying we shouldn't have to pay property tax. It's like, you're the wealthiest, these poor 20-year-olds that have no money, can't afford a housing. You got millions and you don't want to pay property tax. Give me a break. But no, my generation has really ripped you people off. It's pretty amazing. You should see Medicare and some other things, just how bad it is. So, but that's a different question. How do you solve that? I mean, the easiest way to solve the Social Security is to push back the retirement age from 65 to 75 or 80. I wish they would at least adjust Social Security retirement age for mortality, what our expected life expectancy is, because the 65 years when it was set, we were not expected to live that long. Now we're expected to live to 85, and we haven't changed the 65 at all. So we're giving people more time. So, and that same 65 impacts these pension plans. So I don't know if y'all realize when they started Social Security, there were some elderly, some senior citizens that were really mad. It's like, you're telling us we got to quit working and take money from the government? They're like, that's an insult. We're going to keep working. The times have changed a little bit today, right? So any questions on these 4 risks? Pretty straightforward risk. Very difficult to manage the first 3, but the 4th one, which is the biggest one and the most impactful, that's the easiest one to manage. Arnott said, at least take care of the 14% at the tail. I'm saying get rid of all of it. So how much are we aging now? This is Whistler's mother at age 67. Sophia Loren at 77. Have y'all noticed how much older people look when you go back, look at pictures from 30, 40 years ago? We're aging, maybe not me, but a lot of people are aging pretty well. I mean, she looks pretty good at 77. You could say the same thing with some others. Raquel Welch, she passed away. I think both of them have passed away, but they both look pretty good. We're aging much better. We're living longer. We'll see what AI does to us and the fact that we sit at desk all day. But longevity risk is a risk that is ultimately going to become a huge issue. It's probably going to be a bigger issue for Medicare and Social Security than these pension plans, but it is going to be an issue. All right, a little bit more on interest rate risk. There is a problem with the accounting. They did fix a lot of the accounting, but the one thing they didn't fix was the discount rate. For private pension plans, they use the current yield on an investment grade corporate bond with a duration similar to the liability. That's what we did at USAA. We went out and found an investment grade corporate, what that yield was. We actually did it by duration. So we said, okay, cash flows out 3 years, use this discount rate, 5 years uses this. So we actually use the yield curve or the corporate curve. What is the corporate bond curve? Well, those are bonds that can default. They have risk. Why are we using a yield curve that could have risk? Do pension plans default? Do they go out of business? No, that's the liability you've got. What discount rate should we use? We should be using the treasury yield curve. We'll use the corporate curve. So the liability is actually understated by quite a bit, probably about 5–10% because we're using corporate yields and not using treasury yields. So I don't like that. But for public pension plans, they get used to discount rate, which is the expected return on their assets. So they get to put the stock market in there and they can say we're going to make 8%, 9%. And the auditors let them get away with murder on this. What does that do to their liability? Grossly understates it. And why haven't they changed that? Because states like Illinois are already bankrupt. You make them change the discount rate in a pension plan, they're really bankrupt. So they get to exaggerate. Now, when I started the pension plans, we got to do what the public side does. We did the expected return on our assets. If we were 70% stocks, we think stocks are going to make 9%. We're using pretty high discount rates that radically reduce our liability. We're really understating our liability quite dramatically. The true discount rate should be treasuries. But that was a little bit of a compromise. GAAP accounting is not economic. There is some political compromise that goes on. This one change, remember, this one change caused GM to have to write off $16 billion. If they had gone to treasuries, it would have been another $9 billion or so. It would have been huge. So I like GAAP accounting better now. It is much more logical, but I wish they would change the discount rate to a true discount rate. But at least they're getting closer to something that's more economic. This discount rate generally moves. Now you're going to see this is pretty material when we talk about 2008. This discount rate generally does move with treasuries rates. But what happened in 2008? Treasury yields fell, corporate bond yields went up. So the liabilities actually fell in 2008, even though they should have risen because interest rates fell. So it does have a big impact. But the public side is quite a mess. All three of them are tied because pension plans have very long durations. They're very sensitive interest rates. So, the discount rate using, whether it's using treasuries, corporates, or even the expected asset yield, they will be sensitive interest rates because interest rates do influence all three of those. But it's not symmetrical. These liabilities have very high positive convexity. They move up much more when interest rates fall than they fall when interest rates rise. That's really, really important. It makes it much more difficult to hedge it. Y'all have seen that already, so you understand that. So what could be a solution to this? So you've already seen R-naught solution. What did he say? Hedge this right here, that 14%. What is my solution? Have y'all heard this term before? Balance sheet immunization. Sounds pretty familiar. You've already done it, right? You did it for a bank. All you got to do is do it for a pension plan. So I've talked about this. I talked to a life actuary. Why are pension plans 70% stocks when life insurance companies are 100% bonds when our liabilities look really similar? And what did he say? Because you guys don't know what you're doing. So what does balance sheet immunization say? The first thing you do is you look at your liability. And I think that's true with all investing. The first thing you do when you're going to invest is you figure out, why am I investing? Because you're investing for some future purpose, right? Are you investing just because, you hate buying jet skis today? It's just much more fun to spend money in the future. Would you rather spend money today or in the future? I mean, if I gave you, I say, hey, I'll give you $1,000 today, or I'll give you $1,000 in 5 years. Which would you prefer? $1,000 a day. What's the only reason you wouldn't take the $1,000 today? I'll give you $2,000 in 5 years, maybe. All right. Why are you investing? You'd rather spend the day, wouldn't you? It's a lot more fun to spend the day. So why do you invest? You invest because you have some future cash flow you want to fund. What is that cash flow? Are you going to buy a house? Are you paying for your education? Are you saving for retirement? Each of them have their own specific lower risk. So you want to look at that and say, what drives that liability? Because I want to make sure I invest in a way that gets me to that goal or whatever that future need is. So invest to mitigate those liability risks. This can be true for you, for your retirement, but in a very different way than it is for corporations. So balance sheet immunization says, don't start with the assets, start with the liabilities. When I go to parties, I went to one where it's a bunch of my old friends from USA were there. Saw this one guy I hadn't seen him in years. He introduces me to his wife. Say, hey, this is Ron. He's a portfolio manager at USA. And our first question is, oh, should I buy gold? Like, oh, okay. Well, why are you buying gold? Why are you investing? What's the purpose? Is this for your retirement plan? How much do you have? I can't answer that question. You buy gold. Yeah, you should buy gold if gold prices are going up. If they're going down, I wouldn't buy gold. That's would be my recommendation. But I can't answer that question. I don't know who she is, what she's investing, why she's investing. The thing I do when I'm speaking to groups, I was speaking to one group and a young guy said, hey, how should I invest as a young person? My answer is always, I don't know how you should invest, but if I were your age, this is what I would do. I'm kind of backdoor giving them advice without giving them advice. I'm just going to say, you may be radically different than I am. I have other reasons, but if I were you, if I were living my life at your age, this is what I would do. Because everybody's different. People have different needs and requirements. So start with that. Why are you investing? And what does that look like? What is that? Investing should be you're funding some future cash flow. Now, I deal with one guy here in town. He's very wealthy. He's from India. He started a couple of businesses. He sold them. He's doing great. You should hear his story. His son wrote a book, and it's a really incredible book. This guy came to US with nothing and started two businesses. He's worth, tens of millions of dollars. Why is he investing? Well, most of his money is going to go to his kids. Does that mean this doesn't apply to him? Well, no, he's kind of say, I'm investing for my kids. So you can essentially look at his kids and say, how would they invest? What are they investing for? So he essentially just substitutes his kids for that liability. So he still has a purpose for that cash. Maybe he's going to give it to a charity. He's got to think about, what does the charity need? How should I invest? But you want to ask, why am I investing? Look at those four: liability risk, interest rate risk. Anybody remember the four of them? The ALM risk. What was the first one? Longevity risk, anti-selection, inflation, interest rates. Of those, interest rates are the easiest to manage. That's true for many, many, many liabilities, as interest rates do tend to dominate. And you notice that with the stock market the last few years, what is everybody focused in on? What's the Fed going to do? What's the Fed going to do? Everybody's so focused on interest rates. So interest rates is the most straightforward, mainly because we do have those interest rate swaps that make it really pretty easy to manage the risk with one phone call. There's no good hedges for longevity and anti-selection risk. It was interesting at USA. Oh man, we're going to run out of time. Boy, yep. Can y'all sleep till midnight? Maybe not. But at USA, one of the life actuaries came to me, and they were insuring USA's employees on the life insurance side. And they were having some problem because they had, especially some executives that had some health issues, and they're like, man, this is going to cost us a fortune. So he comes to me and says, okay, Ron, you got this pension plan. If our employees live a long time, you're in trouble. If they die too fast, we're in trouble. Why don't we just create a hedge? If people die too fast, you pay us. If they live too long, we'll pay you. So that's kind of interesting, right? We could hedge each other. But then I started thinking, is it possible that the employees both die too early and live too long? And actually, it is possible. Why? Because it's not the exact same group of people. And so I couldn't, the basis risk we're going to talk about basis risks. He wasn't insuring the exact same people our pension plan was covering. If it was, yeah, I could say, yeah, they're either going to die early or they're going to live too long. We could hedge each other. It wasn't interesting. I thought about it, looked at it, but uh, and a biggest problem was he was only insuring people who were current employees. The pension plan had people who already quit, on other jobs. I had this much different group of people. So it's very, very difficult to hedge those. Hedges for inflation risk are extremely difficult. They're very expensive. There are inflation swaps where I pay you SOFR and you pay me inflation, but there's just not much volume that you just can't get. There's not that many people that are worried about inflation falling. Most people are worried about it rising. You just can't get the other side of that. So that one's tough. We manage it again by under hedging on the duration side. Maybe our duration should be 20 years, but we'll do 18 years to give us some of that protection from the inflation side. So, so you need a significant amount of long duration bonds to offset that. Capital markets don't do that, but interest rate swaps, dollar duration gap analysis, it's actually quite simple to do. So again, my first swap that I purchased was a very short phone call, very simple to do. Now I had to rely on the actuary because I was really relying on his forecast of cash flows. Smart guy, enjoyed working with him, really fun guy to work with. Kind of a typical actuary, just in the numbers, very serious, but a nice guy. And we worked really well together, two different departments. But I had to rely on his numbers. And once he gave them to me, I did the calculation. What's the duration of the liabilities? What's the market value of the liabilities? What's the duration of my assets? What's the market value of my assets? Subtract them. That gives my dollar duration gap. I call the swap dealer. He says, hey, I got a 30-year zero swap. I take the dollar duration gap, divide by 30, and I'm done. Can you imagine? It's that simple. Eliminated massive amount of interest risk for USAA in a 10-minute phone call. It's pretty wonderful, isn't it? Finance, man, there's some smart people who come up with some really smart stuff. So, and I was smart enough to take advantage of them. I could have never created all of that, but I'm smart enough to say, hey, the tool's out there. It reduces our risk. Let's go for it. Let's do it. All right. Any questions on that? How many pension plans in the United States did that? The top 1,000, it was one. So we went way out on a limb. I lost a lot of sleep. I remember the exec council was on the committee to approve this. So I went to them one by one because it's pretty complicated to explain it to them. They all said, yeah, this makes a lot of sense. Let's do it. We all got together in a meeting and the CEO goes, does anyone understand what Ron's talking about? They all said, no, we don't know what he's talking about. I just met with each of them like an hour and a half. He says, Ron, you can't propose this to us. So you need to go around and meet with them individually. I'm like, yes, sir, I'll do that. So I went back and met with them individually. This next meeting, you have to realize in finance, this is pretty important. The people at USA, they're very smart. These execs are very smart, but they're not finance people. So I'll meet with them on something this complex. 3 weeks later, what's going to happen? They're going to forget the whole thing. Not because they're not smart, it's because this is a small part of what they do. What saved me at the next meeting, the CEO wasn't there, and Christy was running the committee. Christy is a life insurance actuary. She was the CEO of the life insurance company. Guess what a life insurance actuary said when she saw this? The whole room turned and looked at Christy and said, Christy, should we do this? She said, absolutely. And that saved me. So that was really good. They're still, after 2 meetings with them, they're still like, we don't know what you're talking about. They did understand it when I presented it to them, but when you let 3 weeks go, I mean, this is stuff that's really hard to learn. So Christy saved me in that, and because she absolutely understood this. It's exactly what a life actuary would do. So that helped quite a bit. So what I want to argue is not only do pension plans, should they hedge the way I'm talking about, I'm going to argue that they have a moral responsibility to hedge. If you have a pension plan, the federal law, ERISA, the Employment Retirement something Act, ERISA says every decision you make on that pension plan can only have one beneficiary, and that's the participants in the plan. All right. If I put the pension plan 70% in stocks and the stock market goes up 40%, who wins on that? Do I go out and tell the pensioners, hey, we're going to kick in more money on your pension? Do we do that? No, they get the exact same pension. So how do they benefit if the stock market shoots up? They don't benefit at all. What happens if the stock market crashes? Now we got a pension plan that's got a $3 billion liability, but the assets are only $2 billion. Do they benefit from that? They're harmed from that, right? Because now you don't have the assets to pay their pension. So sticking a pension plan in the stock market is of zero benefit to the participants, and it actually can harm them because you may not be able to pay their pension plan. So the fiduciary nature, we'll talk about this more next week. The fiduciary nature of pension plan, I believe, argues that you should be doing balance sheet immunization because your goal is to pay the beneficiaries. Your goal is not to make as much money as possible. But most corporate plans, they saw the stock market rising in the 90s, and their pension plan was actually a profit center, and they loved it, thought this was really good. And they kind of got hooked on that. And then the 2000 stock market crash, the 2008 stock market crash, they started seeing, wow, it's maybe not as good as we thought. But for the longest time, they were making decisions that were almost entirely in the benefit of the corporation, not for the participants. I asked my lawyers, could I make the argument that I would put it in the stock market and make the pension plan less expensive, make it more likely USA provide the pension plan to its employees? Maybe that's in their benefit. It says, no, that argument doesn't work. So if I'm going to do something solely, this is the actual words, solely in the best interest, solely. Doesn't say primarily, doesn't say the corporate has some interest in this. It says no, the plan participant. And why is that? Because it's their money, right? You should have paid them in a salary. Instead, you kept their money. You're keeping their money. You better invest it in a way that you ensure you're going to pay them when they retire. All right, I'll stop it there. Y'all see where we're going here. We're getting close to the end. So what I want to do tonight, finish up this discussion on borrowing to invest, and then I want to go back. I'm going to show you the rubric for the exam, and not to depress you, but I'm probably going to have you do the exam in class, not in advance. And I'm starting to discover AI is becoming a major issue, but I'll let you have the rubric on the exam, but you got to understand it. What amazes me, I mean, it still amazes me when COVID hit that I've converted all my essays to online open book, thinking the grades you're going to usually average is a C. I thought it's going to go from a C to an A minus. And guess what it did? It went from a C to a C. Makes no sense to me whatsoever. People see the rubric, they're writing their exam, open book, and they completely leave out an entire section. I just don't understand that. I do see a lot of phone zombies, iPhone, smartphone zombies in my classes. They're just destroying their lives. I don't think there's any way to save them. It's probably too late now. And that's probably part of it. So yeah, you've just got to find some way to let this sink in. This is really, really important stuff because it's applying the finance that you learned that you can actually apply it to a specific problem, not just on an exam, but actually at work. That was my fun at USAA is essentially my job description was make USA better. And it's just like, there's so many opportunities everywhere. You're just listening, you're asking questions, challenging convention, but you've got to be able to draw on what you learn in school. So a lot of students, it's like, what we learn in school is textbook stuff. I'll just learn it enough to pass, and then I'll do the important stuff when I get out. That's just not true. The stuff you're learning is actually important, needs to be known. So let this stuff sink in. It really is that critically important. All right, so let's talk about the fiduciary side of this again. So a pension plan, a 401k plan, the federal government says when a corporation sets these up, the only decision criteria should be solely in the best interest of the plan participants. That's what a fiduciary is. A fiduciary has that, which means for me doing this plan, I could be sued personally if I mess it up. the participants in the plan can sue me, which makes me nervous doing these kind of things. USAA had, $7, 8, $9 billion sitting in these plans. All these employees, if I think I'm messed up, the fiduciary nature of pension plan, I think, argues that it should use balance sheet immunization. I think it's just obvious to me. And we talked about that last class because anything else you do, stock market, none of that benefit when it works goes to the participant. When it messes up, it harms the participant. I don't see how you can argue that that's in the participant's best interest. So I believe they should be hedging the plan assets. And when it does mess up, the stock market crashes and it does mess up. I mean, think about 2008. So you've heard the phrase perfect storm. You know what a perfect storm is? So sometimes perfect storms is like these unrelated things all happen together and it's like, wow, that's freaky. This is a perfect storm, which was so predictable. So you have a serious recession in 2008. Stock market's going to crash, interest rates are going to come down, and companies are going to go insolvent. So what's going on here? You've got the pension liability is going to increase, although we'll talk about that a little bit with the discount rate. Stock market's crashing, so the pension plan went from a surplus to a deficit, and there's more likely that that company is going to go insolvent because it's a great recession. So their pension plan is going to go underwater the same year they go insolvent, which means what? It goes to the U.S. taxpayer, the PBGC. We'll talk about something stupid the PBGC did after all this. So then it ends up in the taxpayers. The beneficiaries still lose. While it's insured and the PBGC is going to bail them out, it's not 100%. You're not going to get all of your benefits. You're going to be worse off. So you say, wow, that's just a perfect storm. But not really. You would expect all those things to hit at the same time. That's just the nature of the stock market and interest rates. So it ends up going to the taxpayers. So I think the federal government should be encouraging firms to do balance sheet immunization. Now in Great Britain, they do. Great Britain pension plans buy a lot more bonds than the US do. They use a lot of interest rate swaps that actually kind of hurt them some a few years ago. But in some countries they do. In the US, we didn't have that tradition. I believe firms place a significant amount of their pension plan in the stock market. They're violating that fiduciary responsibility. What you should be doing is maximizing the probability that they're going to pay what they promise. That should be what a pension plan is doing. And a balance sheet immunization does exactly that, but it does even more. So it's the best interest plan participant. Am I saying this is the best interest plan participant, but it hurts the corporation? I'm going to actually argue that it benefits both the plan participant and helps the corporation. So let's talk about the impact on the firm. And I will say, we're going to get into this. Well, I'll get into it here. I'm actually a big fan of pension plans, and I think it's actually sad that they're going away, and I'll explain why that is. I think we're going to see a huge impact in the United States when all these people retire without adequate retirement because we've done away with pension plans. So we'll talk some of that. But the impact on the firm, how do you increase? Now I love this slide. I used to have Bill Regan, Dr. Regan. He was my first boss in finance, first boss's boss. Scared me to death when I first met him. Very intimidating person. I'm a type B personality. He's like type A squared personality. Very, very intense person. I loved working for him. I learned not to walk in with my memo in my hand because he would just start ripping to shreds. He knew how to write. He was a very, very good writer. Had a PhD in economics, edited a lot of textbooks, just a smart guy. He was constantly going, yeah, Ron, what does that imply? What is this theory? What did you learn in your college? He was always like, what do you know that can address this problem? Just smart guy. And he spoke to my class once. I haven't asked him back because he was talking about utilities. Some of us talked to Rafa, who works for utility, trying to understand this industry. He was over all of our heads really fast. But one thing he said that I clicked on that I really liked, he said there's two ways you increase the value of the firm. Two ways to increase the value of the firm. You increase its free cash flow or you reduce its cost of capital. I would know that, man, I would use that in an interview. So if I'm in an interview, they're asked, tell me about yourself. Well, I want to work at a place where I can add value and they want me to add value. I want to increase the value of this firm. And you do that by increasing free cash flow or reducing risk. I want to do that. I want to find ways to increase free cash flow or reduce risk. That's the kind of employee that you want to be. How do you increase free cash flow? Well, you do positive net present value projects. What do pension plans do when they invest in the stock market? Remember what the net present value of that is? 0 to negative. So we're not doing that. What are we doing to the firm's cost of capital when we invest in the stock market? Actually making it worse, right? We're doing this pension plan, which itself is like really excessive debt, very, very interest sensitive debt that also has a cost of living adjustment. So the pension plan itself is increasing the cost of capital. So the pension plan is really harming the firm's value because essentially we're borrowing money from our employees in a way that's extremely sensitive to the economy. So if we buy investments in a pension plan to hedge interest rate risk, what are we doing? We're bringing the WACC back down. The pension plan itself increases the WACC, but by hedging it, we bring the WACC back down. What's the net present value of investing in stocks? 0 to negative. What's the net present value of investing in long-term bonds? 0. They both have a net present value of 0, but only one of them reduces your WACC, and that is balance sheet immunization, right? And why do stocks and bonds have the exact same net present value? Well, because your discount rate reflects the risk. You have a higher discount rate for stocks because they're riskier, lower discount rate for bonds. They have the same net present value. I was talking to a couple of y'all about this yourself personally. I've heard people say, oh, I got this mortgage. It's, it's a 6% mortgage. I could pay it off early, but I'm just going to invest in the stock market because I can make 8% in the stock market. That's not a good decision. Why? Well, what is that 6% mortgage? How risky is that? What's your return if you pay down your mortgage early? What will you make? 6%, risk-free. Can you make 6% risk-free anywhere in the world right now? The US Treasury is what, 4.1%? Yields have been falling. If you can make 6% risk-free, when the 10-year Treasury is paying 4.1, you should make 6% risk-free. That's the best investment you can make. And to say, well, but I can make 8% in the stock market, you're comparing apples and oranges. You're comparing something that's high risk to something that's 0 risk. And that's kind of, I think, what the pension world is doing is, yeah, stocks have a higher return, but they're also much riskier. Those two net out. You end up with the same net present value. There's no value added to the firm. However, if you're going to have a pension, maybe the best answer is not to have a pension plan, then your WACC doesn't go up. I actually like pension plans. But if you're going to have a pension plan and your WACC can go up, at least invest the pension plan so you hedge that risk out and your WACC comes back down and you don't harm the value of the firm by having a pension plan. So I think the firm is better off, even though they can't make that their reason. The firm's better off and the participant's better off. Everybody wins in this scenario. Questions on that? I would bring this up in interviews. It's a great phrase because it's pretty simple, isn't it? Man, you can really describe exactly your job. This is you for the next 50 years of your life. Increase free cash flows, reduce risk. That's what we do in finance. Really, really simple. Can an accountant explain their job that easily? I'm a CPA, was an accountant for 2.5 years. I don't think I could have made it that simple, but it's pretty simple in finance. That's what we're after. Now, as Warren Buffett would say, it's simple but not easy, but it is simple. The concept's simple. It's not easy to execute. All right. So the balance sheet immunization reduces the firm's cost of capital, increases the firm value. So we just already said that one. So why do pension plans do this if it doesn't make theoretical sense? So part of it we've already talked about, the historical accounting made pension plans look a lot riskier than they really were. So you're dealing with your banks and their risks. They talk about economic capital or economic earnings. What they're saying is forget the accounting. Let's mark everything to market. Let's do everything on an economic basis. So they're kind of admitting, banks are admitting that the GAAP accounting is not economic. Although with banks, banks' GAAP financials are closer to economics than probably almost any other industry. That's why banks pretty closely to a price to book around 1 to 2. Not like tech companies that trade at price to books at 40 or 30, 60 or something like Palantir. Um, they're pretty close. But pension accounting, the old world, the pension gap accounting was not anywhere close to the true underlying economic numbers. And so that let them mask a lot of that volatility. It didn't show up in the gap accounting. And therefore, let's pretend like it's not there. When those accounting worlds changed, a lot of firms, that's when they're shut down their pension plan. They say, we just can't take that volatility anymore. And then the stock market did really, really well in the 90s. People are like, wow, we got all this money we're making. Our pension plan is not nearly as expensive as we thought it was going to be because we're letting the stock market pay for a big chunk of it. What happened after the 90s? What happened in 2000? Dot-com bust. What happened in 2008? Great recession. You had two massive stock drawdowns in a decade after having a whole decade with them. In the 90s, the only really bad year was 94. And that was more of a bond sell off. The stocks didn't really sell off all that much. We really didn't have any horrible times in the 90s. Now, in the 80s, we did. We had the 87 crash and we had the recessions in the early 80s. The 70s were horrible for stocks. You would have really hated being in the stock market. You would have wished you were in real estate in the 70s. So 70s were terrible. The 80s were terrible. The 2000s were terrible. The 90s were pretty great. So we got used to these wonderful returns and we just said, hey, stocks for the long term, that makes sense. Just because something worked, is that a good risk management decision? So if you put all your money in Palantir, that would have worked really well. Do you recommend people put 100% of their money in Palantir? Does that sound like a good? So just because something worked historically is not a good argument for doing it. So it ignores the concept of risk. And also remember the concept of reversion to the mean. If something's worked really, really well, it may be expensive, it may be due for a big sell-off. How did the stock market do today? It's not looking too good, right? It's getting kind of shaky. So I'm actually, when we talked, the author who wrote Random Walk Down Wall Street, I think when you see his video, that's kind of what he's arguing. He has a ridiculous allocation to emerging market stocks, and he's doing it right after emerging market stocks have done really well. And if you had done what he was recommending, you would have really been upset the next 10 years because they didn't do well the next 10 years. All right, so what's going on with U.S. pension plans? So most public firms, or I guess private firms, publicly traded firms, and even firms like UTSA and others have discontinued their pension plans because the accounting rules changed because of those two really bad bear markets in the 2000s. This is an old graph. I could update it. It's pretty easy to update, but most of you are going to get a defined contribution plan. A defined benefit plan, that's what a pension plan is. They're just declining. I don't know if this includes states and cities. So state governments still have a lot of pension plans. They love these things still because their accounting rules haven't changed. I don't know if y'all read the history of the U.S. Postal Service. Looks like it's losing money, and the Postal Service says, well, we're losing money because of our pension plan. If you wouldn't force us to put money in our pension plan, we're actually making money. So their pension plan is the main reason they're losing money. How many of y'all think you're going to get a pension plan in your first job? It's going to work. USA has a really nice 401k plan. I think a match of like 8% or something. When they shut down the pension plan, they increased the match in the 401k plan. So public pension plans are still being offered. These plans have a huge allocation to stock market because their accounting rules allow them to mask that, and they have this belief in the stock market for the long term. Several states are nearing insolvency. A few years ago, California was talking about a budget problem that they were having, like $5–10 billion. And someone said, well, but your pension plans are like $50 billion in the hole, and you don't talk about that because it's not on the books. It's like, yeah, I mean, these are massive. So now this pension tracker went away. It's disappointing because it's a really good website. But they showed how underfunded these pension plans were. So pension plans just in the state of California are underfunded by almost $1 trillion, $75,000 per household. How can it be such a massive number? Well, it depends on how you calculate it. We'll talk about the discount rate issue a little bit more, but they're huge numbers. So remember, state and these public pension plans, their accounting rules understate the problem, but if you really state it economically, you get massive numbers. Pension trackers show the actual deficits, but what the deficit would be if you use good discount rates, and they're just massive, massive numbers. Now, Social Security, how underfunded is that? You know, you can have a debate about that. It really depends on the growth of our economy. You have to make some assumptions, but it's underfunded over the long term. Probably not as bad as Medicare, but it's underfunded. So I like pension plans for employees. They do provide a retirement income that's secure to their employees. Most are moving to 401k plans. I attended the committee meetings at USA, the 401k plan, and USA offered a borrowing option. People could borrow money from their 401k, and they're thinking, man, maybe 10% will borrow, maybe 20%. And the first few months, like it was over half the employee base. People are borrowing money. And what they didn't understand is they're borrowing, say, 50,000 from their 401k plan. And they say, but I pay it back to myself with interest. So I get to pay myself interest. So it's not costing me anything. And is that true? You take $50,000 out of your 401k plan, you pay back 52,000, but you pay back with your own money. What are you missing? Well, if the stock market's up 10%, you lost $5,000, right? You have the opportunity cost. Now, if you borrow money and the stock market crashes, you might be happy. You'd be really lucky. But people are borrowing money as if it was free money because, hey, I got to pay interest on it, but it goes back into my account. It's not costing me anything. Well, why do you have a 401k plan? To invest and make earnings. If you take the money out, you're losing those earnings. And so that's pretty obvious. But my story is a good friend of mine, her cousin worked for USAA. I helped her on her investments. She helped me on my insurance. And so she comes to me like in 07, 08, and I need help on my 401k. So I just wrote up a plan for her how to invest. I thought 2008 was going to be a pretty rough year. So I gave up a plan where she would buy low and kind of get through the market. It really helped her a lot. She did really well in 08. She's kind of excited to invest, but the problem was her 401k was worth 40,000 bucks. She'd been at USA for 30 something years. Her 401k should have been $500,000. It was 40,000. Why was it so low? She kept taking money out of it as she had a son who had some special needs for financing. She was always a new car, refurbishing her house. She had USA's pension plan that was worth $500,000. What would she have done if USA had not had a pension plan? She desperately wanted to retire early. And her 401k was only 40 because she retired early on 40,000 bucks. Even with her Social Security, it just wouldn't have worked. Thank goodness she had that pension plan. And so I felt kind of stupid helping her on her 40,000. It's like, it's kind of immaterial. You got this pretty nice pension plan sitting over here, which is a really good plan, but USA shut that down. She has it. So USA's pension plan is still there for people who had accumulated benefits until they shut it down. So it's still there. It's still a few $1 billion. But without that, she would have been in a lot, even with the higher contributions, she would not have made the higher contributions.
The military also went to 401k type, which
Yeah.
is PSP. So was it like the same reasons because of the accounting?
I don't know on the military side, and it may be a cost thing. I mean, you can make the two the same cost, which is essentially what USAA did, is say, well, we're going to get rid of our pension plan, but we're going to shift all of that cost to the 401ks. So our compensation is the same. It might have been just a headache of keeping track of a pension plan. Military people to me are kind of bizarre, retiring in their 40s, and getting a really nice monthly check. It's kind of nice. Sounds pretty cool.
401k military, because people don't do the full 20 years, so
Okay.
they might do 10 years, but get out with nothing to show for it.
Yeah, so maybe an equitable kind of thing. I'm not saying I'm negative 401k plans, but with 401k, the employees got to make a decision on how to invest. At USAA, I used to, when the statements came out, I would call, like if the statements came out and small cap were up the most, I would call our small cap managers and say, you're gonna get about 50 million bucks tomorrow. And sure enough, the next day, why? Because people get their statement, they move 100% of their money, whatever had the highest return. It wasn't good investment decisions. At USA, it was crazy. USA pays a pretty nice bonus in December, and employees would go in and turn their 401k contribution off for the bonus. So they didn't get USA's match. Like, why are you doing that? Oh, I just want the bonus. Yeah, I mean, you're throwing away free money. So employees are not good at managing their money, and employers are really playing some silly games with 401k plans. I will say, if you have an employer that bundles their 401k plan, you should be up in arms and you should complain because they're ripping you off. USA tried to bundle theirs and I fought hard. I went to one meeting where I was going to follow my sword for that. Fortunately, the present investment company shut it all down. But what is a bundled plan? That's when your employer says, we want to take advantage of our employees to help reduce our costs. We're going to make it sound like we're doing them something good, but we're actually going to rip them off. So bundled plans are horrible. So employers just don't know how to keep their hands off your money. They do really bad things. So there's a lot going on that is not in the best interest of the participant, even though the federal law says it needs to be. So do employees really have the knowledge to manage their own 401k plan? Certainly there's people out there that charge money to help you. What good are they going to do? They're going to probably charge more than they're worth. So I like pension plans. I think they're quite helpful. My dad had a pension plan, and that, was a really nice check. That was his entire retirement. They had zero money saved up, and he worked it so that when he passed away, it stopped. So my mom was like, so fortunately for her, she had a house in Austin, so we sold her house, and that's now her retirement plan. Plus, she has a wealthy son that kind of helps her too. But we're not going to put her out in the street. But that's probably not good retirement planning, right? Let me assume I outlive you, and if I don't, we'll just have one of our kids will be wealthy. All right, good. Retirement's covered. Get it? That doesn't sound like a good plan. So we do have a retirement crisis in the U.S., and we're going to start noticing it when these baby boomers start retiring. The lady I help with, she did retire early, and I called her, said, how's it going? And she's like, didn't want to talk to me. She bought a new house. She had it remodeled, and it's like, no, don't tell me all that. But she's like, yeah, I know. I shouldn't have done that. I bought a new car too. Like, yeah. But she had the pension plan. That was the one thing that really saved her. I haven't seen studies that shows what is the U.S. retirement situation now these pension plans have gone away. My guess is they've gotten probably noticeably worse. So I like them. It sounds a little paternalistic, but they have been really beneficial for a lot of employees. So most workers in their 50s and 60s are not prepared for retirement. All they have is Social Security. Their 401k plans are woefully inadequate. What can they do? About the only choice they have is to work longer. Either work longer or die faster. That's your two choices, and it's just not good options. I was helping one family. They said we're having some financial issues, and so I go sit down with them, and like they want to retire early because the husband had some health issues, and the wife just didn't like her job. And I go, well, you don't really have enough to retire. And oh, by the way, we have two sons we adopted. They both have a lot of special health needs, so they're going to be living with us the rest of their lives. It's like, yeah, you're not retiring early. And I had nothing to tell them. And you're working, essentially, they're working the rest of their lives. That's not a fun conversation to have. There was no solution I could give them. Almost at that point, you just go out and buy lottery tickets or something because there just wasn't enough. Why didn't they have enough saved up? Well, because they had two special needs kids that were pretty expensive, and that's fine. That sounds really good for them to do that. But the offset of that is they're not going to be retiring when they're retiring because they've made some decisions. I mean, it's pretty tough. Social Security is a lot of people's entire, retirement income. And can you live off of that? Some people can make it work. What a lot of people are doing is called partial retirement. So they may be working retail for 10 hours a week, and that can make a huge difference. There are some solutions that aren't, work 40, 50 hours a week, but it's tough. The question I might ask you that you might not want to ask is, what's your parents' retirement situation? Mine were pretty bad. Guess what your parents' retirement situation is, what their retirement plan is. If they're not ready, you're their retirement plan, right? I was thinking of retiring at 40, and then I saw my parents' retirement plan, so I worked to 46. So I worked 6 years. I worked 18 years for my retirement, and I worked 5 years for my parents' retirement because they just weren't prepared, and I'm not going to, have them not having a good retirement. I mean, why were they poor? Because they spent too much money on their kids, so I'm part of the problem, right? But do y'all know your parents' retirement situation? Are they ready? Are you their retirement plan? And if so, are you ready to do that? That's what we call the sandwich generation, raising their own kids, and they're going to have to support their parents in retirement. And so, it's a crisis coming up. Pension plans were somewhat of a solution to that because it essentially because most employees don't even think about the pension plan. They don't think, wow, you're taking 10,000 of my pay and putting in a pension plan. I could have that money. Most don't even notice it. And then they get to retirement and say, wow, I got $500,000 sitting there. I didn't realize. And so it's kind of a nice little surprise for someone who wasn't well prepared. So I like them. So I think it's sad to see them going, mainly because they weren't well managed. We were rolling the dice in the 90s and it was working, and then suddenly it fell apart in the 2000s. And plans said, rather than fixing it and hedging the risk, we'll just shut them down. This is a big part of my argument. If pension plan had been managed like life insurance companies, which is what they should have been, they just managed the exact same way, we'd have plenty of pension plans today. People wouldn't be talking about them. They wouldn't be that big of a deal. They'd all be solvent and everything would be working really well. But for some reason, and I can't tell you the history why pension plans suddenly started sticking all this money in the stock market, and that just became the way it's done. So it's a scary situation in the US. How does this apply for you as an individual? Should you hedge out the interest rate risk of your retirement plan? And the answer is you don't really need to, because you have one massive asset called human capital. Human capital is the present value of your salaries for the next 40 years. Looks like a bond. It's a massive bond. It's the biggest asset on your balance sheet. Since you have 95, 98% of your money sitting in bonds called human capital, you can stick the rest of it in the stock market and not even think about it. And I would go 100% stocks if I were you. If you're in your 20s, 100% stock, and part of the argument is it is possible the stock market does horribly over the next 40 years, but if it does, so does everything else. There's not any asset that's going to do well if the stock market does horribly next 40 years. So you might as well go for it. At some point, you're going to have to start moving out of stocks and the bonds because your human capital is shrinking. And so you have to think about that. But in your 20s, it's like, let's invest in the stock market. And if the stock market crashes, double up your investments, buy low, get into the market faster. So you're a little different. Human capital optionality is you have the ability to change careers, change jobs. You have things to do that makes your human capital more valuable. The more optionality you have, the more valuable your human capital is. If you can switch careers, switch jobs pretty quickly. I've been talking to a lot of alums. The one we're talking to earlier today, well, both of them, Devin and Rafa, man, they've learned an industry backwards and forwards, and they're extremely valuable. They can easily switch between jobs. They know these industries, these really difficult industries really, really well. It gives them ability to switch to really high paying jobs because they're quite valuable in their knowledge base. That's what you've got to do. You can't waste time not learning. That's why the smartphone is so deaf to students, because they're not paying attention. You should be desperate for knowledge. I don't know if AI is going to change that. We'll see once they put the disk in our brain and you can just go like this and we know all knowledge in the world. But right now, finance pays you for what you know, and the more difficult thing you know, the more valuable you are. So it's pretty simple in finance. You apply to a bunch of jobs and you take the one that scares you the most, because finance pays for complexity, for knowledge. And what you're trying to do is get into your specialty as early as you can, and you're looking for spatial intelligence. And you'll know you're there when you're there. So I got there on balance sheet immunization. So if a balance sheet immunization problem came to me, I could see the whole thing really fast. Like, you know, construction workers, they can look and they can see the whole house. They have no idea, and just on top of their head. They don't have to sit and work. That's what you're looking for. And you don't get that by listening while you're on your phone or on your laptop. You get into depth, you ask questions, you learn. That's where the human capital optionality is. The most complicated thing you can stomach, the scariest thing you can stomach, you learn it deep, and then you're set for life. You're in good shape unless AI takes all that away. I can't promise you that. That's a big risk for your generation. Mine didn't have. All right, so we talked about that one. There's the formula for human capital. You're trying to maximize this. You remember this from last semester? You alive, you dead. You're trying to maximize that. What does U stand for? Utility, your happiness. So what you're trying to do in your life is maximize your happiness in your live state and your happiness in your dead space. That's where life insurance comes in. And essentially what you're doing is you're managing your wealth versus your human capital. When your human capital dominates because you're young, then stick all your wealth into the stock market and just let it ride, unless your human capital looks like a stock. If you're a commissioned salesperson or your income goes up and down with the stock market and the economy, then you may need to be a little safer. But if you have a salary that's pretty predictable, you can put all of your wealth into the stock market and let that ride. So anyway, that's an important concept. All right, let's look at the rubric for this question, and let's see how much of this comes back to you. If Bill Gates will let me get in there. I don't remember when our exam is, but it's I'll give you this rubric. So how much of this can you do off the top of your head? Arnott had 3 groups of risk, but I said 4. Anybody remember the 4 of them? Peer risk, which is what? Alpha risk, which is the risk of what? Yeah, underperforming your peers, underperforming the market. What's the second risk? Career risk. What is career risk tied to? Peer risk. And why is that? Why is alpha risk tied to peer risk? I mean, why is career risk tied to alpha risk?
You'll do something different, you get less gains and fire you.
They're going to fire you. So it's compensation, right? We're compensated based on alpha risk. So that's what we focus on. We focus on where we're paid. If they compensated based on asset risk, that's where we focus. It was on the other, well, I just told you the third risk. So what's the third risk? Asset risk. And the fourth risk, ALM. We spend most of our time on which one? Alpha risk. We spend what's the most important risk? ALM risk. So we spend most of our time on the smallest risk and the least amount of our time on the biggest risk. What are the 4? Well, see if y'all remember this. That fourth risk, ALM risk, it has 4 subcomponents. Y'all remember those? Longevity risk. We live too long.
And anti-selection.
Anti-selection. The healthy people take the pension. The unhealthy people take the lump sum. Inflation risk. Most of the pension plans have a cost of living. That's the biggest difference between the pension plan and life insurance. Life insurance companies don't have inflation risk. Pension plans do. So it does make the problem more difficult. And the last one, interest rate risk. Which of those 4 risks is the easiest to hedge? Yeah, interest rate risk, because we have what? Interest rate swaps, right? So y'all getting them? Well, we talk about this. What's the main focus of investment managers and consultants? It's the incentive. The compensation focuses on peer risk as alpha risk. ALM's the largest. All right, so this is really critical to get an exam. A lot of students just don't talk about this. So let's see if I can say it in words. So you got these cash flows out over many years. The balance sheet's going to do the present value of them, which means the really far out cash flows, how do they show up on the balance sheet? They're really small, right? Because you're discounting them out there. So they're a small percentage of that. They're a big part of the cash flows, undiscounted, but discounted, they're a small part, like 14–15%. But where is most of the interest rate sensitivity?
Or the-
those long. So what did R not say? At least hedge out the interest rate risk of that 15% that's way out there. It's pretty easy to hedge. He doesn't mention interest rate swaps, but it's pretty easy to hedge. Says, yeah, I got good news and good news. Your longest term liabilities have most of the interest rate risk, but because of the present value factor, they're only about 15% of your liabilities. So he's saying you don't have to radically change your asset allocation, just take 15% and match it long term. What do most pension plans do? They buy bonds, but they buy like 5-year bonds. They need 30-year and long duration bonds. So they don't even hedge that risk. He's saying, hey, at least do that. Go out long term. What about symmetry? What word can we use instead of symmetry? Convexity. What are pension liabilities? Are they positively convex or negatively convex? Extremely positively convex. They go up a lot in value when interest rates fall. They don't go down as much in value when interest rates rise. They're much more skewed on positive. It's called positive convexity. That makes them pretty dangerous liabilities to have. Arnott argues the balance 2 out of 3. Why do I disagree with that?
Can we leave that one unmonitored, that becomes your major risk?
Yeah, and if one's much bigger than the other two, why not just focus on the one? That's my argument. That's my, don't worry about your cholesterol level when someone has a gun to your head. Hey, let's deal with the biggest problem and take care of that. And we talk about his bond allocation. He said pension plans, first of all, they don't have enough in bonds, and the bonds they have aren't long enough duration. They're buying far too short because they have this liability that's extremely interest rate sensitive, has a lot of positive convexity. And they need to buy bonds that is going to handle that particular risk. This is not my solution. These two things here are not solution. Balance 2 out of 3, and at least hedge that 15% that's long. I'm just like, hedge the whole thing. Why not? So be like a life insurance company. He's like, just tweak it a little bit. Buy a little bit more in bonds and go longer term. And it's true that will reduce a lot of the interest rate risk, but you still got a lot left even if you do that. All right, questions up to there. That's the Arnott article. You'll see where we're going there. All right. You can tell if I give you this rubric, you're going to have to write a lot more. You can't just write what I have written there. So how do you increase? So I might take out some of the words here. How do you increase the value of a firm without reading that?
By increasing
Free cash flow increase. Reduce the WACC. All right. Pretty simple. I love that phrase. When he said it, it's like, man, and he was good at that, right? I used to go to him with 5-page memos and he would cut it to half a page and say more than half a page. And I said in 5 pages, that's a pretty smart guy. And he got the whole of finance in just that one phrase: increase free cash flow or reduce WACC. How to increase free cash flow? Positive net present value projects. Yeah, I mean that's your whole career right there. What does debt do to your cost of capital? And increase your cost of capital. And we're talking about pension plans here. It's going to especially increase your cost of capital because pension plans are unlike any other debt. They're extremely interest rate sensitive. They have a cost of living adjustment. They're very impactful on the cost of capital. If you invest in markets, what's the net present value there? Whether it's stocks or bonds, your present value, net present value is 0. Even if those stocks have a higher return, they have the same 0 net present value as buying bonds. Why? Because you adjust your discount rate for the risk. So the higher returns offset by the higher discount rate, you end up with the same return. And even then, you can say it could actually be negative net present value because most firms spend a lot of money on managers to try to beat the market, and they usually don't. Quite overwhelmingly, they don't. In fact, we used to use active managers. I finally gave up on it, but we used to active managers. So we hired consultants and we went out and interviewed all the consultants that bring managers to you. And I added a question to the request for proposal. I said, once you recommend a manager to your clients, how does that manager perform going forward? That'd be a pretty good question, wouldn't it? And all of them were 50%. Once they recommended a manager, their managers on average did about as well as throwing a dart at a dartboard, right at the 50th percentile. Why are you paying these consultants all this money? Well, because boards don't want to get sued. They're not hiring consultants because they think consultants are going to add value. They're hiring consultants because then they can say, see, we did our diligence. Don't sue us. We did what we're supposed to. Spending money just to cover their assets. All right. So remember, this is important. This net present value, because we're talking about should they buy stocks and try to get the higher return or buy bonds and immunize the balance sheet? They both have the same net present value. So you're not adding any extra value by investing in the stock market. So then you have to think about if you're going to buy stocks, is that in the best interest of the plan participants? And so think about it. If the stock market does well, they get no benefit. If it does poorly, they could be harmed by it, or the US taxpayer will be harmed by it. I think it violates the fiduciary responsibility. So what is my recommendation? You saw it, I showed you last class, return on the assets, X%, return on liabilities, X%. Any questions? It went from an hour, 2 hour presentation down to like 10 seconds. Pretty straightforward. And what was the focus of the presentation? Are the assets doing what they're supposed to do? Funding the liability. That's what they're there for. That's what they should do. Another way you could put mine is I think pension plans should be managed the same way life insurance companies manage their liabilities because they're very similar, make a lot of sense. Life insurance companies aren't shutting down. Pension plans are shutting down, but life insurance companies, they do a lot of bad things. If you take my life insurance class, you'll notice I don't like that industry. But when it comes to the stuff like pension plans, which is their fixed annuities, they manage those extremely well. They're very dangerous products, but this industry has managed them extremely well. Why? Because they're focused on that balance sheet immunization. So what happens to the value of the firm? If you take my approach, you got those two prongs: increase free cash flow, reduce WACC. Stocks versus bonds, neither of them do any better on the net present value side. The stock's going to hurt your cost of capital, but investing in bonds, hedging out that risk, reduces that cost of capital. So that's my argument. Now, what argument would the AT&T guy say? But stocks have done well recently, right? All that value given up since 2008. If you've been in a stock market, you would have a whole lot more money now. Well, 2022 would have been bad, but the last few weeks would have been bad. So that's the opportunity costs. What's my argument on that is, yeah, higher return and higher risk. It is higher risk. The stock market could crash pretty badly. So think about it from the stockholder standpoint. Should AT&T borrow money and stick it in the stock market? And I would argue, if I'm an AT&T stockholder, I didn't hire them because I thought they were really good at picking stocks or investing in the stock market. I hired them to be a telecommunication firm. What could the investor do? Well, the investor could borrow money and invest in stock. They can do this themselves. Do I, as an investor, want AT&T to borrow and invest in the stock market, or would I rather do it myself? How many of you are buying AT&T stock because they have a pension plan invested in the stock market? It's like, wow, man, stocks are doing so well. Man, I hope they increase that pension plan. They can borrow that money for their employees, put it in the stock market. That's a lot easier to me just borrowing, investing on margin. No, it's not. It's a lot easier for you to do it, and you've got control of it. Why would you want AT&T to do it? So they're not doing you in your favors. They're doing exactly what you could do yourself, but they're doing it in a firm that you're investing in that you're not investing in because of their pension plan. You kind of wish they would just hedge it out. So I don't like that argument, but that's the argument people will make. Do you think there's life insurance companies going out there? Man, I wish we'd been in the stock market the last 20 years. No, I've never heard a life actuary say that. They know exactly what their business is. They know what their liabilities are. They understand the risk, and they've done it well. But that opportunity cost is the biggest argument you make. Man, you give up on some pretty big returns in the market. So can y'all handle this on the exam? If I give you almost as this rubric. I'll probably reword some of it so I don't give the answer away. Even bigger, could you explain this entire thing off the top of your head without any notes? Because if you interview for jobs, most of the pension plans out there are 60, 70% stocks. So you probably don't want to have that debate in an interview. A little dangerous. If you interview with HEB, they have a pension plan. They do a lot of private equity kind of stuff, and they do kind of the traditional stuff. You probably don't want to have that debate, but you probably want to understand the issues and be able to talk to them if those came up. So it's a little bit of a dangerous topic because very few people actually invest the way I'm recommending, but you certainly want to understand them. But you really understand something if you can sit down, and probably the best test is go find your 10-year-old nephew and explain this entire thing to him. And if he understands it, then you understand it, right? Could you explain this to your 10-year-old nephew? So now he may not know what net present value is, so you got some more explaining to do, but that's how you know when you really understand something. All right, so I want to show you, I do want to talk about the paper some, but I do want to show you. I want to talk about 2008 and what happened. So we did this like a couple years before 2008. I invested in a swap. Interest rates were pretty high when we got in. I think the 5-year treasury is at 525. In fact, the day we did the swap, I still remember the 5-year treasury had jumped up to 525. I was like, man, this is the point I want. That sounds like a pretty good rate, right? If you're worried about rates falling, locking in at the 5-year at 525. And so we hit it kind of just perfectly, more luck than skill, but we hit it just about perfectly. So let's look at the heads first. So the blue line is the discount rate for our pension plan. When the blue line falls, the liability shoots up. When the blue line rises, the liability falls. We hedge it with the interest rate swap. The interest rate swap, I got a typo up there for some reason. The interest rate swap, same thing. When interest rates fall, the swap is up. When interest rates rise, the swap is down. How good is this hedge? Right here, we would have been pretty happy, right? The liability risen some, but the swaps would have risen a bunch. Right here, the swaps would have fallen more in value than the pension plan, but does it look like it's a pretty decent correlation? We'll talk about basis risk a little bit later, but it's a pretty decent correlation. You can see a few places where it'd be a little bit off. It doesn't look bad. All right. Now, are y'all sitting down? Everybody's sitting down? So what happened in 2008? This is what I almost had a heart attack in a way because I wasn't over this department at that time. I'd moved over to the investment company, but I was telling them, you just experienced a once in a million year event. You need to do something. Chris, yeah, I'll copy it over once I show it, but y'all ready? Y'all are sitting down, right? This makes finance people pass out. It's incredible what happened in 2008. All right, so moves pretty well together, right? There's 2008. Right here, what did our liability do? Fell in value. What did our swaps do? Shot up in value. Right here, the swaps were worth over 500 million bucks. How much did we pay for them? I remember. How much does a swap cost when you enter it? Zero. Would you like to spend zero and have over 500 million bucks? Be kind of nice, right? That's when I can say, hey, I paid my salary. this happened. I met with the department on this day, and my argument was sell this and buy that. My argument was that's a once in a million year scenario. It's not strategic, it's completely tactical. And remember how I set up the swap? They could sell this quickly. Now, do you want to buy these triple B bonds? Well, what was 2008? Late 2008, it was a buyer's market. Do you want to be a buyer in a buyer market? I don't know if y'all know Oak Tree Capital. Oak Tree Capital, I always forget the guy's name, a really famous guy who runs Oak Creek Capital. Oak Tree Capital was buying triple B bonds in 08, and they're about the only ones buying them, and they made a fortune doing that. It could have been Oak Tree Capital and USAA. We could have been out there buying $500 million in triple B bonds. I mean, would you rather buy them at this yield or at this yield? I kind of like that yield, right? And we met on this day at the extremes of them. My department said, well, we want to do a strategic review and before we make a move. I said, no, you don't need a strategic review. You need to move. They decided to wait. They did the trade here. So kind of upset me. I had talked to everybody in the investment company, all the fixed income guys, and they said, you need to do that trade before January 2nd, because a lot of the reason this was happening was year-end window dressing. When January 2nd happened, it was going to unwind. So they waited, probably a couple of $1 million worth they threw away because they didn't move immediately. But it was even worse than that. So my boss was running the committee at the time, and he comes back and I said, did you ask them about the swaps? He said, yeah, I did. And he said, we're hedging. They're just paper gains. It's like, yeah, they're paper gains unless you do what? If you trade, they're no longer paper gains. It says they need to trade, but their argument, and this is something we're real careful of, we can make this mistake in finance. We're a hedge, we don't need to do anything. How does this hedge work? This hedge blew up, didn't it? It blew up in your favor, which is nice. It's a lot worse when a hedge blows up. If you have a hedge and it blows up in your favor, shouldn't you be thinking about maybe doing a trade? But their argument was, we're hedged, it's accounting, it's a paper gain. It's like, yeah, execute. Sell this for 500 million bucks. Go out and buy that for 500 million bucks. Call your bond investor portfolio manager. It's like, hey, we want to invest $500 million in this market where there's nothing but sellers. You're going to walk in as a buyer. My word, you're going to name your price. You're going to get some incredible bonds. Your bond portfolio manager would be like, this is crazy. I can't believe y'all want to buy 500 million, but we can do it. We got people desperately wanting to do it. I don't know if they could have gotten it all executed right here. They probably would have lost some on that. But that argument of, well, we're hedged, so we don't have to do anything. And I remember telling my boss that as the committee chair, and I go, no, that's not true. And he got really mad. He slammed his fist on the table. I was like, is he mad at me or is he mad at them? But he was mad at them, unfortunately for me. And so he got the meeting together and we met. I was like, sell the swap today, start investing the triple B. I've got like 10 people in the investment company all saying the exact same thing. And they said, no, we want to do a strategic review. And what did our strategic review say? It kind of said the same thing we've always been saying. So they didn't actually do much on that. So you've got in finance, you've got to always be paying attention. And when these things happen, you better be sitting down and talking about them. So these opportunities, man, they come up every once in a while. Probably in your career, you're going to have 2 or 3 of these. And you don't want to be the one to say, we don't need to do anything. We're hedged. No, you gotta act. So this was absolutely crazy. They still did extremely well. I could actually show you how it worked. Right, nothing's happening. Yep, everything's frozen. So here's how we were expecting this to happen. We had a portfolio of $3 billion and we did a swap at 850. Why does the notional sound so small? Because we did a 30-year swap. So it made it huge. We had a pension liability of 2.7 billion. So our pension surplus was 300 million. Let's say interest rates fell 200 basis points for all 3, the bonds, the swap, and the liability. Remember, our bonds had a pretty short duration. Most pension plans go out 5-year duration, but we had to get a swap to pick up that duration. If that happens, what happens? Your bonds go up 300 million bucks. Your swap goes up to 510. That's exactly the value. I think our swap got up to 516 or something. It got up pretty high. So your assets rose from 3 billion to 3.8 billion, but what did your liabilities do? They have a duration of 15 years. They went from 2.7 to 3.5 billion. What did your surplus do? Went from 300 million to what? 300 million, perfectly hedged. That's the way it was supposed to work. What happened in 2008? Interest rates on the bonds actually went up because they're corporate bonds. Interest rates on the liabilities went up because they're using the same discount rate as the corporate bonds. And the swap went down. What happened then? The bonds actually fell in value, but so did the liability. The swap went up in value 300 million bucks. USA's net worth, the pension plan went from 300 million to 900 million dollars. And that was with them delaying for a few weeks. If they'd done it faster, it would have been much higher. Were we expecting this? No. There's where you say, okay, you messed up on your job. You're supposed to be hedging, but at least it was to our favor. You think they were complaining? They weren't complaining. They were kind of happy that we were lucky on that. And so it worked out. USAA, out of the 1,000 largest pension plans in the United States, 999 of them went from a surplus to deficit. USA was the only plan that had a gain like that. Not because of any skill, it was all luck. But I mean, when you get the luck, you act on it. That my old department was like, just let it sit there. They were going to throw away the entire 600 million bucks and just let it dissipate over time. It's like, so at least they did finally act and at least capture 600 million of that and not let it go completely out of whack. So this is what I'm proposing, and this is the way it should work. Now you might be asking the question, if this can happen, could the opposite happen? And it did. That's what happened here. They came back together, so you would have seen a lot of it dissipate. Fortunately, they unwound it. They got most of this. What they lost was this right here. And I have to admit, maybe they didn't lose as much as I said because it moved pretty fast. Maybe they couldn't get the money invested as fast as it would have liked. It was a pretty good market for investing. Let me see if I can find that Oak Tree Capital. Because he's a famous, y'all know his name? Howard Marks. Have y'all heard of him before? Who's heard of Howard Marks? So look up Howard Marks, find him on YouTube, read what he writes. He's very, very thoughtful. He comes up with one-liners better than anybody. So if you ever listen to him, you're probably writing down his one-liners, putting them on a t-shirt because he says some pretty incredible things. But his firm was actually buying bonds in 2008. One of the few firms actually buying bonds when everybody else was selling. And he talks about that. If you can find his discussion of 2008 and his courage to step out there and buy these bonds when people were just scared to death to invest, it's pretty good. So I think he's still around. There he is. I mean, he's getting up there in age. But you can probably find quite a few YouTubes of him talking about his theory, his philosophy. He is a bond guy, so you might think he's not that interesting, but he does take some pretty bold actions, and he has a pretty good way of expressing his philosophy that I think it makes him an interesting person to listen to. All right. Does all this make sense? Y'all see how it all lines up? The swap yield and the corporate bond yield moves all together. You did that dollar gap analysis, dollar duration gap analysis. It works perfectly. But then you have to realize you have some basis risk because interest rate swaps and corporate bond spreads don't always move exactly together. But that's your goal. Eliminate a lot of risk for the portfolio. All right. We covered the Arnott article pretty well. I'm challenging you to be able to do do this table off the top of your head. Let me just show you the convexity side. So let's say you have $500 for 30 years. And let's say you start with a rate of 6%. What if it falls to 5%? What if it rises to 7%? So you take 500 divided by 1 plus the rate, raise the time. That gives your present value there. What is it going to do if interest rates fall to 5%? The value goes up or down? Interest rates fall. Goes up. What if interest rates rise? What is it going to do? Go down. How much does it go up? We go up 33%. Yeah, that's right. I don't know what that is. What if rates rise? How much does it fall? Falls 25%. That's that asymmetry right there. You can prove it just by doing the math. If rates fall, it goes up 33%. If rates rise, it only goes down 25%. If we make it even more extreme, I'm sorry, you really start seeing that positive convexity. Convexity gets much bigger the further out you go. If we go really extreme, you're going to really notice that positive convexity. You're going to be much more hurt when rates fall than you're going to be helped when rates rise. So that's the convexity side. So that's why I think I like this chart, because it so simplifies the whole formula. You have short-term liabilities, long-term liabilities. You see that argument that Arnott's making, that you can get rid of a lot of risk by really focusing on the long end of the curve. So we got his article out of the way. Did y'all take a picture of that? You'll get it here later, so I'll put it. When is our exam? Is it like tomorrow or something? I can't remember the exam, or is it two weeks away or something? So, start practicing it. You know, road trip. Hey, I want to talk about immunizing pension plans. You know, you might riding somewhere with your grandmother. Hey, can I talk about immunizing pension plans? She might know it better than I do, so interesting. All right. So paper one, just a quick few minutes on this. You should be making some headway into this. So you have an introduction section where you're going to talk about this documents out there on Canvas. You're going to be talking about the bank's risk philosophy, their process, who's the players, what kind of committee structure they have, the board's involvement, the audit committee, do they have a chief risk officer, those things, type of things. Then you're going to focus your intention on the market risk. They'll probably call it market risk. That includes interest rate risk. Some people call it price risk. I think all of your banks call it market risk, and the interest rate risk will be part of that. You're going to define it. Remember, when you define it, make sure you're quoting the bank. Some students like get my definition of market risk and put that in their paper. I don't care what I think it is. I want to know what your bank says it is. And you'll have a definition. Every bank has a definition of that. It will also, in that definition, include what it includes. And you'll see that in the valued risk. Remember with, was it Bank of America, that interest rate risk, equity risk, commodity risk, currency risk. You saw those. So what are those subcategories they look at that would be good to put in your definition? And then you're having and I would have these well documented with bolded titles in your paper. Then you're going to talk about how do they measure it? How do they mitigate it? On the measure side, you will definitely be putting tables and charts from your annual report into your paper. It's really critical that you show that. So for market risk, you're going to see things like stress tests. Some firms, they talk about stress tests and then they talk about earnings drawdown. To me, earnings drawdowns are stress tests. It's just a different kind of stress test. So we did stress tests. Remember, on the balance sheet immunization, we asked, what does net worth do if interest rates go up 100 basis points? They go down 100 basis points. That's a stress test. Some banks do that, but they look at not net worth, but they look at earnings. They may call it earnings drawdown or earnings at risk. They'll have some title along those lines. They may call it economic earnings at risk. What does that mean? That means they're going to mark more things to market and not follow gap accounting precisely. All of your banks do stress tests. All of your banks evaluate risk. That's probably going to be a longer section of your paper because that's pretty critical. It's a major risk measurement for banks. Almost all of your banks are going to be using historical VAR. We'll talk about VAR more even before your papers due, so you get some practice on that. Historical VAR just means you're looking at like the last 100 days and saying you take our current business, and if the last 100 days had happened, how much could we have lost 5% of the time? Parametric VAR is what we're going to be using on the first and second exam, but parametric VAR is essentially using statistics like mean and standard deviation and correlation to figure out the risk. It's using statistics. And then stochastic VAR is when you're using like Monte Carlo simulation, running a bunch of simulations and scenarios. Your banks might do stochastic, but I'm guessing almost all of your banks are using historical VAR. Find their risk tolerance. They say it backwards. They say their risk tolerance is 95%. I work for an insurance company and we do it the other way around. We say our risk tolerance is 5%. It's the same way, whether you're saying the right side of the tail or the left side. So if they say 95%, then they say 95%, well, we won't lose more than this. And the insurance side, we say 5% of the time we expect to lose that or more. So it kind of depends which direction you're going. But most of you, I think all of your banks do it at the confidence level, like 95%, 90%. Do they talk to the results? You definitely want that table. I showed you Bank of America's. You definitely want to put that table in there. You might compare years. It can be, as I mentioned, very interesting to compare 2021 to 2022, given what a horrible year 2022 was. That can give you some insights. You'll see that interest rate risk pop up pretty dramatically. And the equity risk probably too, because the stock market sold off pretty high. So there's quite a bit of things you can do on the value at risk. Many of your banks do VAR back testing. See if you can figure that out. It's pretty straightforward. They say, well, how good of a job did our VAR do actually to tell? And if we said 5% of the time or 95% of the time we won't lose more than $50 billion, how much did we actually lose 5% of the time? That's kind of that VAR backtesting. But talk about that. I think most of your banks do that. I doubt your firms do this, or if they do, they're not going to tell you about it. The duration of assets, liabilities, like we're doing on our balance sheet immunization problem, I doubt they're going to do that. At USAA, we did calculate the duration of those, but we probably would not have reported them outside because they're pretty subjective numbers. But look and see if they say anything like that. They might use terms about very sophisticated state-of-the-art models or those kind of things. Who knows how they call it. See if you see the word economic in there, economic earnings, economic net worth. Any kind of ongoing monitoring, reporting, that can be part of your measurement side that you're actually putting those numbers out there. Your banks may be doing other things, but all of your banks are going to have most of these with the possible exception of that one. This is all on the measurement side. It is important you get the measurement stuff under measurement and the mitigation stuff under mitigation, that you understand those. Then when you get the mitigation, the number one mitigation is correlation. You'll see that in that VAR table where they say, hey, here's all our risk, but subtracting this because of correlation. So that is the number one risk tool. But make sure a lot of students leave this out entirely. All of your banks are going to be using derivatives, just like we did for balance sheet immunization. Interest rate swaps and futures are the most common ones. You'll probably have a table that shows those. Now your bank might do credit default swaps. That's for the credit risk. That's not for interest rate risks. So credit default swaps is a mitigation for credit risk. So you're really looking for interest rate swaps, interest rates, futures, and forwards, and those type of things. Even swaptions would count. So find some schedule. Some firms use terms like hedging, natural diversification. You can just read through the text and see what they're saying they're doing to mitigate this, but correlation is a critical one. This one's a little tougher, but a risk limit just says how much are we allowed to lose on this. So you essentially calculate the VAR and you say, hey, if it's over $15 million, we got to reduce our risk. So that would be a risk limit. So the VAR is a measurement. The risk limit is the mitigation. So you calculate your VAR, you get 56 million bucks. Your limit's 50 million bucks. Now you've got to cut back on the risk somehow. So look for that. Sometimes they're called risk budgets. Mostly they're called risk limits, but they may have some other term. And then a lot of banks do loan securitization. Loan securitization is an interest rate risk where you're taking these auto loans and mortgages and you're essentially selling them out into the market so you don't have all that interest rate risk. So almost all of your banks, if not all of your banks, are doing that. But what I'm curious about is if they list securitization as a risk mitigation technique under your market risk. So you might look up the term securitization and see where it is in that annual report, see if it's actually considered part of the risk management. So I've kind of told you what's in the paper. What you got to do is find it in the annual report, quote them, bring in tables, discuss it, put it in your own words. So it's a tough paper because of all the jargon, but you should be able to handle it. Some of your banks do have jargon that you can't Google, you can't ask me because it's their own specific definition. So you have to just figure it out from context. So you might find a term JP Morgan uses, you go Google it, and it's like something radically different comes up and it doesn't make sense. So there are things in the annual report of these banks that is their term that they use internally. It's not a industry standard word. Do your best to try to figure it out from context. All right, any questions on that? I'd like to, at one time, actually, before the papers due, is have y'all actually break into groups and talk about what you found. But